Welcome everyone. Thanks for joining. I'm Gabe Schreiber. I'm a senior manager here at Eide Bailly in the International Tax Group. I am in the Boulder office, and I appreciate you taking time out of your day to think about what it means to go global. The agenda for today is the key considerations for global expansion, minimizing your tax costs, including corporate income tax, indirect tax, individual tax, and then also thinking about some opportunities as you expand globally. So we have quite a bit of material to get through today. So let's get started. There's a lot of things to think about as you look at going global. I'm a tax person, but you can see tax is just one piece of the puzzle. There's going to be a lot of things to consider. You're going to have a lot of balls in the air. One of the first things to think about will be, why are you going global? Is it for expanding your customer base? What will you be doing internationally? How will you be selling or growing internationally if you are selling? Will you contract locally? Will you refer these sales back to the United States? There's going to be a lot of decisions that need to be made related to the people that will be involved. You know, there's a lot to think about in terms of where will you go internationally. Location is critical and sometimes a big decision in the beginning of the process. Technology is important, legal considerations, financial, including your financial system, your ERP system, and then lastly, tax. And I always like to say that it's important to not let the tax tail wag the business dog. So whenever I talk to a client about growing internationally, I always want to hear about what the business wants to do. What is the operations team trying to accomplish? Why are we going international? And we can generally make the tax fit into that plan. But I really want to understand what the business purpose is for growing outside the United States. So let's get started. So the products or services, are you growing internationally for sales? Is it distribution, manufacturing, support services? Why are you expanding globally? There's many different options here. It can be just that you want to hire a team of engineers in another country because there's a lot of talent there and it's a lower cost. Or it could be that you're going to Europe because you want to start selling your products into the EU. So there's many different ways to expand internationally. There's no one path. And so that's why having a good business plan and thinking about the business purpose is very important. One of the initial steps is, what portion of the supply chain do you intend to expand overseas? And we generally recommend a phased approach as you grow, because there's a lot to think about and a lot to take on, and it's really hard to do it all at once. And so it's good to sort of grow your international presence with your business in a sort of a phased approach. People is very important. Who's going to take the lead in this expansion process? Generally, it's a finance or operational person that we end up working with. And so in country, are you going to hire local talent? Are you going to send a US team overseas to launch the business and run it? How are you going to compensate these people? Is it going to be equivalent to your US team? Is it commission? Is it salary? Is there a pension plan? If your US team gets stock, will your foreign team also get stock? One of the questions we get a lot is that we don't want to hire employees, we just want to hire contractors. And similar to the United States with the employee versus contractor determination, a lot of established economies around the world have similar considerations. And just by using a contractor, it does not avoid a lot of the employee considerations. A PEO is a professional employment organization. Those can be used. Another term would be a GEO, a global employment organization. There's a lot of companies that offer this service. They play a role, but they're generally temporary in nature. It's not a long-term solution. And lastly, one thing to think about is, if you have an employee manual, how do you update that for your new markets? And so that's the people side of this. Those are things to think about. Next is, where are you going to go? Are you looking to hire, a specific skill set? Is there a supplier or distributor you need to be nearby? Are you growing to tap into a customer base? The first three are really business considerations. Political, currency, and tax are usually ancillary points. If you're expanding into a country that's dealing with some political turmoil, there's a lot to think about there, especially with what's happening in the world right now. And lastly, real estate. If you're going to the UK, London is very expensive. So those are things to think about as you pick the location for your expansion. On the technology side, what financial system are you using? Can it handle multi-currency entries? Will it be able to handle the indirect tax considerations to give you the data you need to do GST and VAT? Can it do a consolidation so that you can get a consolidated financial statement produced? What ERP system are you using? There's a lot of customs compliance that needs to happen. There's some supply chain consideration if you're moving physical goods. And then for your website, there's a lot of privacy regulations now with GDPR and all the other local regulatory issues. Are you going to have a multilingual web page if you're expanding into a nation that doesn't have English as the primary language? Legal and regulatory is incredibly important. I highly recommend, if you're expanding internationally, you engage with both US legal and local country legal. It's incredibly important to make sure that you think about the local regulatory environment, intellectual property protections, employee agreements, immigration considerations, if you have customer and supplier contracts, import-export regulations are a big consideration. So much of the economy these days is digital, but a lot of people still sell products. And so if you're moving physical goods into the European Union, it can be very difficult. And there's a lot to think about there. Entity selection and setup is part of the role that I play in terms of forming a subsidiary. What type of entity are you going to form? Making sure that you're registered to do business. You have an accounting firm hired to do the local tax returns. Those are certain things that we can help with and make sure that we're thinking about all the right things. On the financial side, there's local employees versus expatriate payroll. We'll get into a little bit about what that means later on. There's employment tax withholding and reporting, similar to our system. A lot of other countries have social taxes, payroll requirements. There's the corporate income tax filings. There's not just your US tax return and the disclosures that go into that, but also filing foreign tax returns, making sure you're aware of the due dates and you have people in place to oversee that and manage those filings. Some countries have statutory audit requirements. Some of this is based on revenue, but if you have a statutory audit requirement, there are countries that require that to be completed in order to do the tax return. Public reporting requirements, and then VAT compliance and remittance. And we have a VAT example later on that's very good. So minimizing tax risks and costs. There's a lot to think about with just tax. There's corporate income tax, individual taxation, and then indirect or VAT tax. We'll go through each of these in a little bit more detail. For corporate income tax, one of the first questions that we consider is determining whether your activity in the foreign country will cause a taxable presence. This threshold varies by country, and one of the big considerations is whether or not we have an income tax treaty with the other country. If we have an income tax treaty, the threshold for taxation is a term called permanent establishment. And generally, permanent establishment is defined in the treaty, but it is a fixed place of business through which your trade or business is carried on. And the definition of a fixed place of business is generally open for interpretation, especially in the COVID times where everyone is pretty much able to work from home most of the time. So that's a big consideration. And each country has their own interpretation as to whether or not the activity will create a PE or permanent establishment. And so it's really important to have that conversation early on with the local country to see what their interpretation of the law is currently and whether or not your activity will create a PE or taxable presence. If there's no tax treaty, the threshold is definitely much lower. In the US, if we have people coming here and there's no tax treaty, the threshold is just carrying on a trader business, which is loosely defined in our rules and not that hard to achieve. So that's the first question, is determining whether or not your activity will create a taxable presence. So in order to answer that question, it's really helpful to understand what you plan to do in country. What type of people will you have in country? What will their roles and responsibilities be? What kind of guardrails can we put around their roles and responsibilities to help manage this? It's really helpful to have a short-term plan along with sort of a long-term goal. And so we try and grow your international footprint as your business grows. Some activities that can happen outside of the US include sales, services, e-commerce. As it relates to sales, there's within that category, there's a huge difference between a salesperson that is, doing marketing work and referring customers back to the United States to sign contracts versus somebody that's in country negotiating contract terms, entering into contracts, signing customers up. Those are very different roles and responsibilities that can lead to drastically different tax answers. So having that business plan outlined is very helpful. For services, again, this can be internal services, this can be external services, internal shared service center like accounting and back office support or engineering type services. Customer type services are also applicable, where maybe you have customers that are using your products and you need people on the ground to help troubleshoot issues or repair things as it comes up. And lastly, e-commerce is a big one. The global landscape on tax is changing because of e-commerce. And so if you're in the e-commerce space, there's a lot of countries with new digital service taxes and other types of withholding taxes on e-commerce companies that didn't exist 5 or 10 years ago. So it's very important to be aware of how the local country is going to view your operations and then ultimately tax those. Sometimes if there is not enough substance to tax the activity that you have in the foreign country, we may still suggest that certain disclosures be made to the government in that country to start statute of limitations and make protective filings. So it's very important to have these conversations up front so you know what you're getting into, and we can advise and help you plan your growth into that country. So once we've figured out the local country taxation, the next step is to think about how this is going to be taxed in the United States. And we have it's not considered a worldwide system at this point, but it generally does sweep up a lot of the worldwide activity into US taxation. So as we think about growing internationally, we need to think about what type of structure you want to use. Are you going to use a deferral or corporate CFC? CFC stands for Controlled Foreign Corporation type structure, or do you want more of a flow-through structure where the activity from a US tax perspective is viewed as happening in a branch or a partnership and then flowing up to the US? We have deemed inclusions here where activity can be subject to current taxation in the US, regardless of whether or not a dividend is paid. That is our subpart F and GILTI regime. GILTI stands for Global Intangible Low Taxed Income. It was part of the 2017 TCJA reforms. Another consideration is the transfer pricing that needs to happen. We have a couple slides later on about transfer pricing, but it's very important to think about this up front. And lastly, IP use or transfer. If you have IP in your business that's going to be exploited outside of the US, even by a related party, it's very important to think about that up front, do transfer pricing correctly, and ensure that the tax and economic ownership of the IP aligns with your expectations. Because a lot of countries, if it's not buttoned up, can try to assert economic ownership over your intangible property and try and tax additional profits from that intangible property in country. And lastly, there is state taxation. Every state is different, and the way that they tax foreign earnings is different. So it's important to think about this as you grow. If the owner of the international expansion is an individual, there's a few things to think about that is different than a corporate shareholder. And this would also apply, to a partnership that's owned by individuals that's expanding. So the three different structures would be a branch or flow-through structure, a corporation, or a hybrid. A hybrid is an entity that's treated one way locally and a different way for US tax. So in the branch structure, there's no deferral. Current US tax is the marginal tax rate of the individuals, and there is a foreign tax credit available if you're paying taxes locally. If you're operating abroad in a corporation, you can get qualified dividend treatment, which is 20% tax. Qualified dividend treatment is only available if the foreign operations are in a treaty country. If you're operating outside of a treaty country and you receive a dividend from that foreign corp, it is taxed at ordinary income rates. Corporations do have GILTI for individual shareholders, and generally, unless certain elections are made, individuals are not able to use a foreign tax credit for taxes paid inside of a foreign corporation. And then the US treatment of hybrid entities can vary significantly. So oftentimes we get questions as to what's the best structure to operate in, and the answer is always, it depends, because it really varies based on who the shareholder is, where are you growing internationally, what does the tax structure look like in the US, and what type of entities will you be using abroad. A lot of flexibility was introduced into the system with what we call the check the box regs in the 90s. So you can sort of decide how you want to operate, but it's oftentimes modeling is the best way to determine what structure to be in, because without doing some modeling and looking at the math, it can be very difficult to provide a good answer. If we have a corporate shareholder, so a US C corporation that's going to expand internationally, same three options: a branch, a corporation, or a hybrid entity. Again, these are the branch, corporation, hybrid entity are for the foreign activity. Similar to an individual, a branch is currently taxed at the corporate rates of 21% because that activity is viewed as happening inside the corporation. And there would be a foreign tax credit available if you're paying taxes locally. If you decide to use a foreign corporation, the 2017 TCJA introduced a dividends received deduction. So if you have profits that have not been taxed currently in the US, so sort of untaxed income in your foreign corporation, you can return that to the US and it can be tax-free. Still GILTI subpart F deemed inclusion considerations. Corporations are able to take a foreign tax credit for foreign taxes paid inside the foreign corporation. And then there is a export incentive, which we'll talk about in a little bit, called FDII, foreign derived intangible income. And that is available on intercompany sales. So it's a big export incentive that was introduced as part of TCJA. And lastly, the hybrid is still an option with a corporate shareholder, and the treatment of that can vary based on country and treaties. So the two options for structure are a pass-through structure or a deferral structure. Pass-through being a foreign partnership, a foreign branch. We use a term disregarded entity. A deferral structure being a foreign corporation. And so in the pass-through structure, hybrid entities can be used. The check the box regulations that came out are very important here, where you're able to, for the most part, decide how you want the US to view and tax the foreign entity. You can elect to be a flow through, or you can elect to be a corporation. It's a very powerful tool that is very helpful. And in a pass-through structure, income is taxed currently in the US, but there are some benefits to that at times, in that individuals have greater access to foreign tax credits. And generally, I mean, this is a big generally, it's preferable in a high tax jurisdiction to operate in a pass-through structure because of the foreign tax credits. The deferral structure can provide a higher after-tax earnings available for reinvestment. GILTI, which is our anti-deferral regime, applies. Similar to Subpart F, which is another anti-deferral regime. If the foreign earnings are subject to a high enough rate of tax locally, there is a high tax exception election that can be made such that GILTI or Subpart F does not apply. Currently, the effective tax rate needs to be 18.9%. So a lot of Europe have statutory tax rates right around 19, 20, 25%. So generally the effective tax rate can be high enough to qualify for the high tax exception. Again, US corporations are allowed a dividends received deduction. A US individual cannot claim an FTC, a foreign tax credit, out of a foreign corp without making a 962 election. Those elections are complicated and should be done with proper modeling and advice. And again, if the dividends coming out of a treaty country, you can get the qualified dividend rate, 20%. So other considerations when structuring, you can use a US LLC here in the US as you expand, but a lot of countries have interesting views of the US LLC. Specifically, Canada, our friends to the north, do not like the LLC as an entity. They have a hard time with how they view it. And so oftentimes either an actual partnership is beneficial or an actual corporation. It doesn't necessarily matter how the LLC elects to be taxed. It just depends on how that foreign country views the LLC. Individuals may consider inserting a US corporation to own the foreign subsidiaries. Again, this can provide a lot of the corporate benefits that are available that individuals have a harder time accessing. And so sometimes a US corporation is worth considering. Some questions to consider under the corporate income tax. This is a little bit of a summary, but what type of US entity do you have? Again, a corporation, an S Corp, an LLC, a partnership. What are your plans to repatriate profits from the foreign operations? A lot of times, as you're just getting into the first parts of your expansion, there's no plan to repatriate profits. You want to reinvest in the business and grow the business. So if we're not taking money out, that's a consideration and can impact a lot of the structuring and tax considerations. What functions and risks will be undertaken outside the US? As we get into the transfer pricing, this question becomes incredibly important. And this question also becomes important as you think about the taxable presence in the foreign jurisdiction. It can be really impactful into the PE determination. And will you be using technology or know-how developed in the US as you grow? This is that IP usage and protecting that IP, both the legal protections, the economic protections. There's a lot to think about as you grow. I hope that that's becoming clear as we move through this. So we'll move into indirect tax. Indirect tax being the foreign equivalent of our sales and use tax. It's generally called VAT, value added tax. It generally should not be an economic cost for businesses. In a perfect world, VAT is borne by the consumer, and I have an example on the next slide that we'll talk through that explains that. It is very similar to our sales and use tax here in the US, except in its administration. It can apply to services. In Canada and Australia, it's called a GST or an HST, a goods and services tax. And the other thing that should be considered is customs and duty. So if you are moving physical goods into a country, oftentimes there is a border tax, and sometimes those border taxes can be what we call input into your VAT input taxes, and you'll see how that works on the next slide. So we have a simple example here that I think really illustrates how VAT works. So we have a supplier, a manufacturer, a retailer, and then eventually a consumer. And as things move through the supply chain and value is created, a value added tax is applied. And so in this example, we're going to assume a 20% rate. And we start with a supplier that has raw materials that they sell to a manufacturer for $1,000. The rate of tax is 20%. And so the total invoice amount is $1,200. And so the supplier charges the manufacturer $200 of VAT. The supplier collects $200 because they started with raw materials. They have no input VAT, and therefore they remit the $200 to the government. The manufacturer takes the supplies and manufactures goods that are now worth $1,500. The 20% VAT means that the total invoice amount for the goods is $1,800. $1,500 for the goods and $300 for the VAT. Now the manufacturer has already paid $200 in VAT to the supplier. And so when the manufacturer sells the goods to the retailer and collects $300 of VAT, they keep $200 to offset the $200 that they've already paid, and they remit $100 to the government. So at this point, they've been made whole. They paid $200, they collected $300, and they remitted the difference of $100. The retailer sells the goods to the consumer for $1,600. The 20% VAT is $320, and so the consumer ends up paying $1,920. $1,600 for the goods, and the consumer pays the full $320 of VAT. Similar to the manufacturer, the retailer has already paid $300 of VAT, and therefore that when they collect $320 of VAT, they keep $300 of it to refill the amount that they've already paid, and they remit $20 to the government. So in the end, the government has collected $320 of VAT, and the consumer has borne all of this cost. It is not an economic cost to the business, VAT, but there is an administrative and a cost of compliance. As our sales and use tax is a transactional tax, VAT is also a transactional tax. And so making sure that your accounting software can handle VAT and making sure that you're working with a local provider to understand what rate of VAT you should be charging, how your invoices should look, that you're collecting and remitting the right amounts is very important and very cumbersome. And it's worth it to think about this up front than trying to figure it out on the back end, because as I said, VAT should not be a cost to the business. And depending on your supply chain, your goods may be zero rated, but you may still have an obligation to file tax returns. So when does indirect tax apply? It generally is applicable before corporate income tax. And it's a really complicated question that depends on what you're selling and how you're selling it. There are, as I said, zero rated goods. If you're not a resident, you may not have to charge VAT. You may not have to register for VAT, but again, it depends on what you're selling, how you're selling it. Is it physical goods? One really important consideration with physical goods is who is the importer of record, which means who is the person that is bringing the goods into the country. Oftentimes for US businesses, it's very helpful for the importer of record to be the local company. they generally have a system in place to do the importation of goods and charge VAT. And so if you can have your contracts, require the customer to take title either overseas or at your dock, and they're responsible for importing the goods, it can alleviate a significant amount of work on you as you move physical goods around the world. The last consideration is that countries are moving to a place of consumption standard, which is a little bit different, and because we have the e-commerce economy. So again, this is a very complicated world. It's very important to talk with your advisor upfront, have some conversations with some VAT professionals in the markets you're looking at selling into, and understanding what your indirect tax liabilities may look like. So with that, we'll move into individual taxation. When we talk individual taxation, we're talking about people that are working for your company outside of their, outside of where they're generally a tax resident. So if you have US based employees that you're sending over to Europe, that's a consideration. It can be hiring people in country that are contractors. As we said, that's a big strategy that people go for. So what phase is the company in? Are you using a subsidiary, or are you in your first push into a country and you have not yet formed a company, and so you're using a contractor? Where is the individual tax resident? This is sometimes a very complicated question. There's local country law. If you're in a country with a treaty, there's treaty considerations. What are the employee and employer obligations? So payroll taxes, social taxes, depending on where you're going, managing tax returns in multiple jurisdictions. US citizens are taxed on their global income. So even if Eid Bailey sends me to the UK to work, I still have to file a US tax return. That is very different than the rest of the world, but it is very important and something to think about if you're asking your employees to work elsewhere. And at what point should your company consider a global mobility program? What kind of policy are you going to have? What is the permanent establishment risk and exposure? And what are your payroll preferences? As there's a lot to think about in this part of tax. So a global mobility program, it generally starts with a company policy. So when we talk about global mobility, we're talking about moving employees to other jurisdictions to work. This is fairly common, and it's very important to understand all of the different tax considerations of doing that. Generally, if a company is asking an employee to work in another country, they don't want tax to be a reason why that employee takes the job or declines the job. And so the company will assist the employee with their tax and help them such that tax is not a factor in making the decision. So we start with the company policy. They need to consider for each assignment. A secondment agreement is where you basically loan an employee to a subsidiary entity, and that's fairly common and can be used to maintain benefits and help the employee with the transition. A tax equalization is a calculation where the tax expense of the employee is calculated as if they had not taken the assignment, and any additional tax that is due is borne by the company, such that, again, tax is not a determining factor in the employee making the decision. Payroll and withholding. A lot of times companies will run what's called shadow payroll, and that can be rather complicated, and need to decide, will the individual be paid out of the home country or the host country? What currency are they going to be paid in? How do we deal with benefits, 401ks? Are we providing a home or a car? The US views those as items of income, and so their wages can go up significantly, and that's where the tax equalization calculation can be helpful. And lastly, the company generally, if we are sending employees around the world, especially if we have a tax equalization agreement with the employee, companies will tell the employee that their tax returns will be paid for by the company, and the company will generally hire an accounting firm to do both the local tax return, the host country tax return, do the equalization, and the employee is basically only paying the tax that they would have paid had they not taken the job. And so a way to manage risk is that the company takes care of the filings of the tax return. And that way, the company sort of has the ability to manage that equalization. So now we have the fun stuff, opportunities. These are the three main things I thought we could cover today. There's obviously a lot to think about. I guess the fourth item that isn't on here would be local country incentives. But so the first one being an IC disc structure. We have a small slide on that. The second one is the FDII export benefits, which is a relatively new regime here in the US. And the last one is transfer pricing, which is incredibly important, has been around for a long time, and can be overlooked by companies, but can be a great area to manage tax and risk. And like I said, I think if I had to redo this slide, the fourth item I would add would be local incentives. So a lot of US states and local jurisdictions have incentives. A lot of foreign countries have incentives, tax holidays, economic development zones, special tax regimes. So it's very important to think about your foreign expansion early and what incentives may be available to you. So let's just walk through these three. The IC disc, it is a separate legal entity, and there is a commission paid from the operating company to the IC disc company. And what that does is it provides a deduction without offsetting income. And then there is a requirement that the IC disc pay a dividend to the owner. And that dividend is treated as a qualified dividend with a 20% tax. Unfortunately, the IC disc benefits have been reduced significantly with the reduction of the corporate tax rate and the introduction of the pass-through deduction. But previously, IC discs were very popular. The FDII deduction is a new deduction. It's section 250 in our code. Again, it was introduced as part of Tax Cuts and Jobs Act in 2017. And it creates a preferential tax rate for foreign income derived by a domestic corporation. And one nuance there is that it needs to be a C Corp. That is the only type of entity in the US that can take advantage of the 250 deduction. And the preferential rate of tax is 13 1/8. That number goes up to about 16% in a couple of years, which is a significantly better rate than the 21% on all other items of income. And there is a small reduction for US tangible property. If you're currently operating in an S Corp or a partnership and you have a significant amount of export income, it may be worth looking into whether or not a USC corporation would provide value. So what type of income is eligible for FDII income? It is really any item of income derived from the sale of property to any foreign person for foreign use. And so a sale is defined to include a lease, a license, an exchange, or other disposition. Foreign use is really anything consumed or disposed of not within the United States. Qualifying foreign income also includes income derived in connection with services provided to anyone that are not in the United States. There is the requirement that you have to allocate expenses to your foreign derived sales or services. So it's a net calculation, not a gross. One area where this is something to think about is if we have partnerships. The Schedule K2 and K3 are new. For those of you that haven't experienced them yet, it's a significantly increased disclosure for partnerships about foreign activity. And one thing that is important is that if you have a C corporation that receives a K1 from a partnership, if that partnership has foreign sales or export income, that C corporation is able to take a deduction for FDII on its 1120. And so what was happening before the K2 and the K3 is that the corporation wasn't receiving the information necessary to know that there was a benefit out there. And so if you have a partnership with a corporate partner, that corporate partner may be asking for more information if you're not already providing it, such that they can take this deduction, or they may want to amend prior tax returns so that they can go back and claim a refund if they are getting good FDII income. And I guess the last thing that's not on this slide that I'll add is you can only take the 250 deduction if the C corporation has taxable income. So if you have a loss in the US, all of the deductions are limited by taxable income. So this benefit's only available if you're profitable, but it is a great tool to reduce the effective tax rate on certain types of income. And it's something that we're seeing a lot of people have historically overlooked, but is very important. And as you consider growing, it may be worth still contracting with your US entity with your foreign customers if possible, such that you can get this type of deduction if you're interested in that. So it gets back to the supply chain considerations, how we do business globally, and it's important not to overlook this. Transfer pricing, as I said, and I'm not just plugging my transfer pricing colleagues, is incredibly important. It's the price charged between entities within the same group for goods, services, intangibles, or financing transactions. And it is very relevant for cross-border transactions, and it can be relevant for interstate transactions as well. Some examples here, TVs manufactured by a subsidiary in China are sold to a subsidiary in France for distribution within France. Transfer pricing can help figure out how much profit the French entity should earn, how much profit the Chinese manufacturer should earn. And the reality is the residual profit should go to the IP owner that has the know-how of how to make the TVs. In the state context, a subsidiary in Texas can perform accounting and finance services on behalf of an Oklahoma parented entity. We have some states that require combined reporting. That's basically consolidated reporting, but there are states that still operate on a separate state basis where you can have deductions in one state and they don't offset with the income from another state. And so there is some planning opportunities there with transfer pricing. And so in the definition of transfer pricing, it really is transactions among related parties. And so that can be supply of raw material or finished goods, intangibles, IT services, management fees. That's a big one if you're expanding globally and your entire C-suite and management team is in the US. We probably need to charge a management fee to the foreign operating companies because you're providing strategic direction. And so a management fee can be a great way to maintain the profit level in the foreign jurisdiction through documented transactions, and it's pretty standard to charge a management fee. And then back office support services is another area where transfer pricing can help price what the value of those services are and how much should be paid for them. A lot of companies have support services in countries like India or the Philippines, and that entity is called a shared services center and has no ability to earn a profit other than providing services to the US parent. And so the US needs to pay for those services, and the local country, such as India, wants a profit on that because they want to tax the value that those people are bringing. And the idea in transfer pricing is to put everyone at an arm's length or how third parties would interact. And so if you were to hire a company in India to do this for you, they would not do it for free. So your subsidiary cannot do it for free, and you cannot just pay cost. usually we have a cost plus arrangement. And so the steps for a transfer pricing engagement is usually step one, we talk about transaction mapping. What types of transactions will you have? Is it a management fee? Is it royalties? Are we selling goods and services? So we need to know what the cost of goods sold is. So first we map out all the different transactions that are going to exist in your supply chain. So we can then in step two, benchmark or price those transactions. So two of the most common is cost plus and targeted operating margin. And those help us determine what the profit levels of the subsidiary should be. Profit is usually driven by functions, assets, and risks. So the more risk you take on, the more profit you can have. So it's very important to get your transfer pricing right, because it's not ideal to ignore, as governments can come in and audit this and adjust transactions and then tax more profit in the local country. Step three is to implement the transfer pricing into your financial system. Candidly, this can be one of the most complicated steps, as these calculations can be complicated or circular in nature. And lastly, documentation. Most of the rest of the world follows OECD transfer pricing, which is the Organization for Economic Cooperation and Development. The US has its own transfer pricing rules and documentation. It's very similar to OECD, so you can generally have one report that covers both. The exception to all of this might be Brazil. They have a very unique transfer pricing regime. And the last piece that's maybe also very important is intercompany legal agreements. Similar to how when you contract with a third party, there's usually a legal agreement there. We expect to see legal agreements for intercompany relationships as well. And so will tax authorities if they come in and audit your local subsidiary. So the last little plug here is, how does an accounting firm like Eide Bailly provide services to its clients that want to expand internationally? And that is through the HLB network. We are part of this network. It allows us to have member firms in the rest of the world that we can call to assist our clients. HLB has been around since 1969, and Eide Bailly is actually the largest firm in the network, not just in the US, but globally. And we actually just had our international conference in Florida last week. And these are people that we know, we work with regularly, we've developed relationships with, and they're excited to help our clients grow into their markets. And so if you call Eide Bailly and you want to expand into the UK, we have a couple firms in the UK. It's a great way to find a local provider that's been vetted and is reputable and is excited to help you expand as we work through all the different nuances. Oftentimes they will also have other suppliers that can be referred, such as law firms or bookkeeping or any other issues that you may need. It's a great place to start. So a little plug for HLB there. If there are questions, hopefully you put them in the Q&A. This is my contact information. You want to jot that down. If not, no problem.
We just thank you all so much for attending. There's no other questions, so Gabe, any final thoughts?
There's a lot to think about. Thank you for attending today, and give us a call if you have any questions or want to talk through the best way to grow your business internationally.
Awesome. Thank you, Gabe, for presenting. Thank you all for attending, and we will talk to you guys next time. Enjoy the rest of your day.